Alrighty. Today I've got Doug Wadsworth with us. Most credit union board members are volunteers. They want to do the right thing, but no one ever really teaches them how. What if the future of your credit union depended on decisions your board isn't prepared to make? Doug, you've spent decades leading small credit unions and advocating for their future. Your newest book, The Board Member Bible, fills a gap that's existed in our industry for years. Today, our listeners are going to hear us discuss what every director should know, the biggest mistakes boards make, CEO oversight, financial literacy for directors, mergers, and protecting the future of small credit unions. Doug, why this book? What inspired you to write the Board Member Bible?
Thank you, Greg. Probably about several months, well, probably a year ago, really, I was inspired to make it. And it was probably because I saw the number of small credit unions that were disappearing. Of course, as you know, working in the industry for a long time, small credit unions really matter to me. I can really see the impact we make on our little communities. And I know what it was. It was actually almost exactly a year ago. There was a town near me, and a small credit union got merged out by a big giant out-of-state one, and it was a healthy small credit union. And somehow I connected with one of the members from that credit union, and they were hot, and they were like, "How did this happen? How did our small credit union get merged out?" And the CEO who was involved kind of got a merger-related compensation that was a little bit, I don't know, some people may be concerned about how iffy that was. There's a potential conflict of interest there. So that kind of got me started. And then I was just concerned about mergers in general. Small credit unions seem to be disappearing left and right, dropping like flies. And I was talking to Scott Pryor with CU's Unite, and he was mentioning about a year ago at one of his conferences I was at, how some CEOs will keep their boards in the dark. And it's bad CEOs that are keeping their boards in the dark. So the boards aren't really aware of what's going on. And so I thought, well, that's a good point. How are board members, volunteers, really supposed to know what's going on at the credit union other than their single source of the CEO? They should be able to somehow pull in some information and training and education from outside of just their own CEO. So I thought, and then particularly around mergers, and then lots of others, how to decipher examiner reports and how to understand financial ratios. So I thought, well, maybe I should write a book about it. So I had written another book, the Keep It Simple CEO, and it was I thought maybe I'd sell 10 of them, but it did pretty well. And
Did
I didn't
it?
do it.
Well, hey, before I had ever even heard your name, I saw the book and I went out and bought the CEO book, and that's really been a treasure trove. I would highly recommend every small credit union CEO grab that book, as well as grab your new book for their board members as well. But
Thank you. And that surprised me because I thought, man, this niche is so small. How many people are really going to get this book? But quite a few people have, and some people have gotten something out of it. This one, the first one, the Keep It Simple CEO, I wrote because, I've been doing it for 25 years, about almost 20 years as CEO here. And our credit union managed to be really healthy. And I thought, you know what? There's a lot of struggling credit unions. Maybe some of what that we've been doing, other CEOs would find useful to help their small credit unions survive and thrive. So that's why I wrote that one. And then after that, I started seeing all the mergers happening. And I thought, okay, who's really in charge of a credit union? The board of directors. And if the board of directors doesn't know any better, they may just merge out without realizing the value they are to their community, without realizing the potential they have to survive and thrive, without even knowing if their CEO needs to be replaced or not. Because who's going to tell them? The CEO is not going to tell them.
right.
So hence the new book.
Yeah. Well, being a credit union CEO myself, I often thought that, we have an election every year. So we have 7 board members, and it's usually 3-year terms. And so we'll have 2 people, then 3 people, and then, on over again in that same cycle. And as we've gotten some new board members, I kind of thought, and so your book comes at the perfect exact time. We just had an election a couple months ago, and we got a couple board members, and I was thinking to myself, we're sitting down, and literally we're sitting down their first board meeting. We have a couple new board members, and we're going through a meeting. we're going through everything. The CFO gives a presentation, goes over all of our KPIs, key performance indicators. We're going over, return on assets. We're going through all of the things that we do in a board meeting. And I'm thinking, these people probably don't even know what the heck we're talking about. And so that I really was, when you came up with that book almost simultaneously as, that kind of thought was going through my brain. It truly is something, for all board members, a lot of things they probably don't think of, but especially new board members that probably don't know half of the stuff that's in there.
Yeah. And even if they know it as a volunteer, they only do spend like an hour a month on it. So how are they supposed to keep it fresh in their minds? So in the book, repeatedly, I remind board members that it's okay to ask questions. Even if you ask the same question every month, it's okay. Maybe this will help as a reference. But how are they supposed to know? They do a little initial training at the very beginning. But
yeah.
And I've been honestly, I've been very fortunate. I've had a fantastic board. My entire tenure here at the credit union for almost 20 years. And before that, board members at the small credit union I was at a few years before that, fantastic board members. So a lot of this book doesn't have a what I did wrong or what not to do. It's mostly here's things that have worked really well.
Gotcha.
When I was on several years ago, I served on the board of the local library, Mid-Columbia Library System. And when I joined the board, they gave me a book and they're like, here's everything you know about how to be a volunteer official for our library. And there's nothing like that for board members of small credit unions.
Now, you've been in small credit unions for a couple of decades, and you fully understand the difference between small credit unions and larger institutions. Why are small credit union boards different than large institutions?
And that's a great question. I actually also worked at a large credit union for about a year and a half. Turned out it wasn't my bag. Didn't like it at all. I wasn't very good at it. Almost lost my whole vision of what the credit union movement is about. But the board members of both are fantastic. And I haven't actually been a board member at a credit union. I just worked with many board members while being in management. It's a little different. Usually the small credit union board members are not compensated at all. Where now often the big ones are. So a little bit different. But other than that, normal members trying to do the best they can. Although, I imagine as a credit union grows, they're more likely to get higher business acumen volunteers. When that happens, naturally, board members makeup on larger credit unions may become increasingly focused on growth. And perhaps get somewhat disconnected from their local communities, especially when they get really big and they aren't really in a local community anymore. So that's a kind of hard question. I don't know how being a board member, how it's different, but small ones are obviously going to be more connected to their communities. For instance, probably like your credit union or mine, all of my board members are right here in my little town because our whole field of membership is this town.
Yes.
So very directly connected to the membership here and hopefully really grasping the vision and the mission of helping people, especially the underserved, people who need it. And for instance, I've got a great board of directors and they're constantly asking, how are we helping the people who are getting overlooked by the big banks? Because they want to make sure our credit union is filling that niche.
And serving its members and community.
Yeah, and the people who are underserved. Yep.
Yes.
Yep.
We've not to completely get off the credit unions forum topic, but we've implemented financial literacy and financial wellness types of programs to help those people that really don't know what to do and how to do it.
Yeah. And that's their credit union difference right there.
Yes.
Which is the heart and soul of small, which is why small credit unions are the heart and soul of the whole movement.
Yeah, I told you I had a presentation at one of the campuses today where we had leaders, managers, and above, about 80 to 90 of them, and the number one part of our philosophy of people helping people, was a big thing that people can understand and relate to, and it has that authentic feel to it. But getting back to directors and what are some of the biggest misconceptions you think that new directors might have when they come on board?
Well, I think generally, and I kind of addressed this at the beginning, was maybe even before they become on the board, they're concerned about whether they're qualified or not. Because perhaps they don't have financial degrees, perhaps they didn't work at a bank. And so what I covered at the very beginning is we need all member perspectives, a broad range. We need a diverse range of member perspectives who can truly represent our local members in our little communities or our little niches. So that doesn't mean they can be a soccer mom, they could be a college kid. They don't have to be a banker. It's nice to have one or two people with a financial background, maybe, but not required. That's kind of what they hire the CEO to do.
Exactly. So for our SEG, I literally was talking with one of the vice presidents, and I had suggested with his background, and since he was retiring, he might want to think about being on the board. And he would have been a great asset for the board, but he just could not get it through his mind. He's like, look, I don't know anything about financial stuff. I wouldn't be able to help. And I'm like, yeah, you would be with your, with your background, you would be an asset to the organization. But yeah, that definitely is.
We just need normal members who have integrity, who care, and are willing to try to do what's best for their community.
Exactly. And are looking out for the best interest of the organization. Now, you talk about the 3 responsibilities of a board. You mentioned 3 core responsibilities. Could you take a few minutes and kind of explain each of those?
Yeah, I broke it into managing the CEO, because we're their one employee, reviewing the financials, which is like typically just at board meetings. So they got to manage you and me. At the board meetings, they got to look at the financials in our board packets and make sure we're healthy. And then they just have to represent the members to make sure that we don't get off mission. And our mission is supposed to be giving those profits back to our members and communities. That's pretty much it.
Okay. Now, managing CEO, and that kind of can go out in several, different areas.
Yeah.
What would you say good oversight looks like when managing the CEO?
Yeah, I actually put I put a list of, I call them commandments to kind of go with the Bible theme on here, about what are some good management practices and what are some not so less effective management practices. So I think I got carried away. Instead of having like 5, I think there's like 10 or something, which is probably a lot. You get too many, it's hard to focus on any. But really, you have to give the CEO enough rope to hang themselves or be successful. Not micromanaging, keep us pointed in the right direction. So we're really focused on the members and what our communities need. And just making sure we're keeping it profitable. And then I've got a whole bunch of little commandments listed in here that kind of breaks that down. Your credit union can't be shrinking. Doesn't mean you have to grow real fast, but you can't shrink because that's not sustainable. So you got to make sure your CEO is doing that. Board should avoid conflicts of interest, speak with one voice, the whole board. So we're not getting pulled. So CEOs aren't getting pulled in all different
multiple directions.
Yeah. What a nightmare. And then how to ask high level questions, not bypassing the CEO. Offering ideas and counsel to us, and just having high expectations. So that's kind of some of the commandments I broke down here. Kind of about a page each. Yep.
Now, finishing up on managing the CEO, and I think this is something that probably at least half of the CEOs that would be listening to this are going to relate to, and that is this next question I got for you under this topic, and that is, how do you avoid micromanagement?
Yeah, that's a hard one. This is a great interview because I didn't get prepared with any of these questions beforehand. So see how fast I can think. So the question is how to not micromanage. Is that what you mean?
Yes.
So I went over that really.
Because some boards, I've experienced it. Some boards do stuff that are dealing with day to day that boards should not be. It's not the board's job. That's what we're hired for, to manage the day to day.
And that's a rough one because how do you change it? Because we're the employee. So that can take years. But in the book, I tried to go over reminders for directors that they're essentially at the 30,000 foot level. Up there, you can't see trees, you can't see animals. All you can see are bodies of water and land masses. And that's pretty much where they should stay.
They're looking at vision, future goals, things like that.
Yep. The general, are you pointing in the right direction? What's that body of water there as you fly by? That's about it. So, and I went into that in depth in the book too. Gave some examples of what's micromanaging, stay out of that is best. I talked to that, I think I mentioned before, there's a CEO, Judy DeLucas, her name. She's at the New Orleans Firemen's Credit Union down in Louisiana.
Shout out for Judy.
Yes, she helped a bunch of small credit unions down there. So I called her, I said, what do you see? What's a common trend among credit unions that are failing, small credit unions that are failing? And she said, it's CEOs that are the boards that are micromanaging their CEO. It's very common because if the board gets too involved in the day-to-day weeds, either the CEO is going to quit or they're doing it because the CEO is not competent and they need to fire the CEO and get a new CEO if the CEO can't handle it. But that's a common one. Another one that was common was conflicts of interest among small failing credit unions. When board members somehow have an inappropriate conflict with money or financials or people. So that was interesting. Covered that a little bit in the book as well.
Now going into one of the other core areas, reviewing financials.
Yeah.
Some directors are intimidated by financial statements. What financial reports should every board member actually understand?
Yeah, and really, hopefully, most people I think are kind of familiar with just a basic balance sheet and an income statement. So I went over those a little bit in here. I even did a little snapshot of what they look like and the important parts of them, to be aware of. And then just really, there's only a handful of ratios that are real vital. Your net worth growth, your ROA, your delinquency. So I think I went over 6 of them. And that's really it. There's like 50 of them that we can choose from. And most of them are just a rehash or overlap with existing ones or encapsulated in just 2 or 3. So I went over those pretty simply in here in the book as well. That's really all you need. If you know what your net worth ratio is and you know which direction you're going with profitability and ROA, that's pretty much the bottom line.
Well, you just answered my next question. That was what ratios do you believe are absolutely essential? So yes. You already answered that question.
There you go. One point.
Yeah,
go ahead. I go over one thing? One point on that one is that I go over in the book is making sure they understand the give back ratio. And I encourage directors to pick a net worth ratio. And as long as you're not shrinking, as long as you're healthy and your ROA is stable enough, when you hit a certain level with net worth, with how much capital have you accumulated, is writing it down and triggering increased giving back to your members and your community. Because we're not supposed to just hoard members' money forever. As long as we're capitalized enough, we're supposed to give that money and that profit back to our members, which also increases our value to our members and it'll help us be healthy and sustainable in the long term.
Sure.
So that's what I covered. Okay, sorry, what were you going to ask?
No, that was a very vital point there. What financial warning signs concern you the most?
About a small credit union?
Yes. That directors should be aware of.
Yeah, really the biggest ones right now, which are industry wide, is shrinking. This is something that just started in the last couple of years. Small credit unions are suddenly really struggling to grow members and grow loans. So if we're starting to lose that and our assets are declining, that's just not sustainable. We can only take that for a few years. And you'll be fooled because as your loans and your deposits decline, your net worth ratio will look better. But that's not because you're getting healthier, you're still shrinking. So that's probably the big one, which is not an easy one. But it's something small credit unions need to come to grips with. Really focus on their niches, differentiate themselves. And if you have capital you can use that to boost to give yourself a boost to really be more valuable to your members. So that's probably the biggest ones I talk about in the book. And what is the cause? Unfortunately, some of it's competitive pressure. And sadly, I did that survey with that advocacy group that I started a year ago. Yeah. I did that survey in most small credit unions. You ask them, who's your biggest competition? It's not banks or fintechs. They're the very bottom. It's the big credit unions around them. So that's a challenge. So now we're having to compete with big credit unions, which is harder to be a great deal because they're also credit unions. So they're also tax exempt.
Exactly.
So the importance of really digging into our niche. And then of course the regulatory burden, that's the other big one that makes it harder on small credit unions. The regs keep getting more and more complicated and they keep passing new regulations for all the big credit unions and they trickle down to the small ones. And then we end up complying with all these regulations that have no relevance to us at all, which uses up our time and money. Makes it harder to compete. So there you go. Maybe those.
Okay. Finishing up on, the three core responsibilities representing members. How can boards stay connected with the members?
That's a good question. I didn't go into that very deeply in the book. I guess trusting in the fact that I've always been blessed to have a really good board who is aware of what more normal members want, because they are normal members. So that's been easy. Of course, you want to have a board that's diverse in representing your membership. If you have a large Hispanic community, a large percentage of your members are Hispanic, then it'd be nice to have a board member on board, because there's different perspectives you need to be aware of and how to serve those members. So that's a hard one. I mean, I guess they could try to look at surveys and whatnot. So far, we've just been lucky, and because we're a small credit union and all my board members are right here in our community, they have a pretty good grasp on the heartbeat of what matters to members in our community. So I think I've been lucky so far. Maybe I'm naive, but yep. And hopefully that's the case with most small credit unions. It shouldn't be too difficult for your board members to have a feel for what's important to the members that they're representing. And usually it's easy.
I would say the majority of them, yeah.
Yeah. And usually it's easy stuff like don't have annoying banky fees, That's members hate annoying big banky fees, so they're right there. Your board can represent their members real easily. That's a big banky fee, we ought to be lower. So yep.
So the next part, let's talk about CEO evaluations.
Yeah. I went into that in depth quite a bit. That's really my most important. As far as compensation for CEOs, I really encourage board members to get a hold of the industry salary surveys. And there's a few different resources, a few different institutions or organizations putting those out.
America's Credit Union puts one out every year.
Yep. They've got one. Gallagher's got one. Q's has one. There's a few out there. And sometimes you balk at the price. You're like, $1,000, worth every penny, because the board's got to know if they're competitive with their CEO in the industry. Other than that, probably as far as...
And then depending on where they fall at on those, those surveys too, because there's a 25th percentile, a median, a 75th percentile. So depending on where you're falling in there too, and where your competitors are.
Exactly. And I went into that as well in the book. Like when I started at my small credit union almost 20 years ago, we were only about 15 million in assets when I started, and we were just about to go underwater. We were losing money. We just got to the point where we were losing money every month when they hired me. And the previous CEO had quit, left to a big credit union. One before her had quit, and the one before that had retired. So I was the fourth CEO in 3 years.
Wow.
And so, and it was my first time to being the CEO. I had management experience from credit unions for about 5 years before that, but this was my first CEO gig. So right up front, I was low on the percentile. I think it was like 20th percentile, because I had to prove myself. And the credit union was small, and we were struggling financially. But as I did a good job, the board was generous and gave me raises. And as our profitability increased and our ability to give back to members increased, eventually my salary came up until we were performing in the very top of our peer group. And then my salary was also in the top of my peer group and got up to the highest percentile. So that was nice, which is how it ought to work. Okay, let's see here. You asked about CEO performance. Yes. So actually I broke down, how can you tell if your CEO is being a good employee? So I went over some reasons of how you can tell if they're a good employee, if a CEO is responsive to them.
Can you share a few of those?
Yes, like big ones. Like if you go to board meetings, well, if the board asks you for something, like how's membership growth going or something like that, then the CEO ought to be able to come back the next month with a nice report that shows exactly what's happening, which means you're responsive. If they have a question, you come back with an answer. And on the other side of that coin, I go into the book about how directors need to avoid just giving their boards errands like a wild goose chase. So the CEO is busy every month trying to track down new reports, and board members are like, I know, let's look up this. And then the CEO is spending all their time trying to track down kind of pointless reports. So that has to be moderated, but the CEO should be responsive. Another important way to tell if a CEO is doing a good job is when a CEO comes to a board meeting with an issue, we as a CEO should already have a recommendation that's researched and thorough. You don't go to board meetings and be like, what do you guys think about this? And then you got a 3-hour long discussion and nobody knows, and it gets tabled until the next meeting. As CEOs, if we're doing a good job, we ought to come and say, here's the situation. Here's what I think. Here's why. And this is what I recommend. So that it's real easy for the board to be like, got it, read it, understood it, approved or denied right there. And then done. Board meetings done quickly, made a decision. So there's a couple big ones on how a board can tell if their CEO is performing well or not. Of course, the other most important way, if a CEO is performing, is, are you financially healthy, which they can tell by looking at the ratios, peer ratios compared to your own, and are we giving back to our members in a valuable way? That's pretty much it. If your CEO is able to, if you're a good employee and you're responsive to the board, and your credit union is financially healthy, and you're giving back value to your members, and your members are happy, and you're a screaming deal in your community, your CEO is winning. So, yep.
So what should a CEO evaluation look like?
Well, evaluation is always happening. And I go over this in the book a little bit. As CEOs, we are always on stage with our board of directors. Every board meeting, every time we talk to them, we are performing to our utmost ability to impress them. That's just how it is. The board has to be impressed with our ability to manage the credit union successfully as the CEO. Other than that, typically what I have done, and this is just my own experience, is, and I think it's pretty typical, once a year, the CEO has to report back to their board right before the new year about how you've done with any goals you've had over the past year. So, and you should have some kind of goals because of your annual strategic planning meeting. So CEO gets to report to the board and say, here's all the goals you set for me last year. Here's what we've done. Here's the progress we've made. And this is what the industry is paying CEOs of about our size based on our health in our category in this area. And so this is the salary I think that I should be paid. So it's the salary request, which is also one of the most awkward things CEOs have to do. I don't know about you, but it's like the most awkward thing in the world. You have to go to your boss with your hat in your hand and say, here's what I think you should pay me. So I always try to keep it as objective as possible and have lots of data so it's backed up. So
now you talked about strategic planning. So what role should strategic planning play in that?
Oh yeah. At least for my own credit union, it's always played a pretty significant role, but you can't really, not 100% because you never know what's going to happen. A lot of a strategic plan, you got to break it down so you have, short-term goals, strategies on how, tactics on how to get there. But you never know what's going to happen. COVID happened, so
yeah.
So we had all these strategic plans, and we're going to launch this these payday loan things through a local ag company here in town. And then COVID happened. And so we had all these goals about how we're going to launch that. It was kind of it wasn't a moneymaker. It was a service to our community. But then we had to drop the whole thing because COVID happened. And then it was like, well, how'd the CEO do based on what happened? So sometimes you just have to fly by the seat of your pants a little bit.
Now, I've heard different statistics. A third up to a half of CEOs will be retiring within the next so many years. So when boards are hiring the CEO, what mistakes do they make when hiring?
I'm not sure. I haven't seen a lot of mistakes. In my own little world, I'm sure there are. The biggest mistake is probably hiring an incompetent CEO, and that can be remedied. So as long as they read the book and they know how to tell if it's a bad CEO or not, that they can remedy it. I would say one is I think, matter of fact, I was at a conference, small credit union conference, and there was a consultant up talking about how boards should hire new CEOs. And this consultant was like, well, you could use those talent search companies, the CEO search, but they're really expensive. And I raised my hand and I said, how expensive are they? And she said, it could be like, I think she said 30% of their salary for the first, or 10% of their salary for the first year. And I was like, for a small credit union, that could be only like $30,000. That's nothing. That's beans compared to the value of getting a good CEO versus a bad CEO. Because a good CEO is going to produce millions of dollars of value that's given back to their members and make sure the credit union is healthy. And a bad one's going to tank you and you're merged and you're gone. So So I suggest in the book, if you can put it out there yourself if you want locally, um, but you can find a talent search company, and you $30,000, $50,000, $100,000 really is a bargain if you're going to find a good CEO. And on the other side of that coin, though, one frequent refrain we hear is that, well, we had to merge out because we just couldn't find the skills and the talent we needed for a new CEO. And I'm like, whoa, 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 whoa. There's a ton of people out there, young people, that could be just a recent college graduate. And man, they may just love the credit union mission and totally be bought into what credit unions are about and making a difference in not-for-profit cooperatives. And sure, they got to learn from the ground up, but what a great opportunity. You can also not have to pay them very much at the beginning while they're proving themselves. And then when they do prove themselves, then you can be generous with wages. So they can be really affordable for a small credit union. And they have the potential to do a really great job. So give the young people the opportunity. I think too many times small credit unions think you have to have a seasoned credit union CEO, a professional, to be a CEO. But
yeah, because there's a good possibility if they're talking to a seasoned CEO, that seasoned CEO is probably not looking for a small credit union anymore.
Right. That's exactly right. Yep. Matter of fact, I got the job here. I think I was only like 35 or something. And that seems pretty young. Now I'd be worried about hiring a CEO at 35 years old. But nope, where did we start? There are a lot of us, in our careers.
So for board members that might be listening, what characteristics matter more than technical knowledge for the CEO?
Yeah, for a small credit union, this is why it's okay, I think, to hire college graduates. Generally, they've shown that they understand business and they can learn. Other than that, if you need to hire somebody with experience, the most important is that they're going to have the passion for the movement. That's the most important thing. But aside from that, what does the CEO need to know? Keep it simple, CEO. You got to know how to keep it simple and run a business, and they got to understand lending, which I think is something you're good at. You came from the mortgage industry.
Yes.
If you don't understand lending, that's the bread and butter of a credit union. So, CEO better figure it out fast,
quickly.
Yeah.
So, camels. Many directors hear camels but never really understand it.
Yeah.
Can you explain camels in a simple language for our board members?
Yeah. There's a great chapter in my book that covers that.
You know what?
Yeah.
Let's take a real quick second, and why don't you tell them the book, how they can find it, and how they can get it in their hands.
Oh, yes, you bet. It's on Amazon. If you just go to Amazon and type in my name, Doug Wadsworth, bam, there it is. I've only got 2 books. There's some other Doug Wadsworths out there, but they're not my books. My 2 are only Keep It Simple CEO and the Board Member Bible. There they are, with the bald guy on the back. You'll see my picture on the back. So yes, but camels. Basically, it's just an acronym, and each word is related to the risk that examiners decide exists at your credit union. Capital, assets, management. They take them all and they break them up into a little letter. And then when they come to an exam, they decide what rating each one is. And they average all those together at the end. And they say, your credit union is a Camel 2, usually. And so I go over that. Basically, Camel 2 is great. You have a little bit of risk, but you're managing it well. But the category of Camel 2 is also enormous, based on what I can tell, because it's a big secret. So nobody's allowed to tell everybody what their camel is.
Right.
But I wrote about that in the book years ago. I had an examiner come. Like when I started, the credit union was almost to go underwater. And so I worked my tail off with a great board and good employees. It took us about 2 years. We got it all healthy again, and we got stable. And then my NCOA examiners come, and they did my whole exam. And I'm like, yes, I'm finally going to become a Camel 1. And they did it all, and they're like, and you're a Camel 2. And I was like, what do you mean? We were a Camel 2 when this place was about to go underwater, and I'm still a Camel 2? And the NCOA examiner was like, well, actually, ever since the housing crash, this was about 2010, we haven't given out any Camel 1s. So a Camel 2, if you were a Camel 1, it probably means your risk is so low you're not very profitable. So really, you should be happy with a Camel 2. It means you have some risk so you can be profitable and you're managing it well. I was like, oh, got it. There was a little CYA aspect in there as well, I'm sure. So generally, though, almost every credit union is probably Camel 2. There's a few Camel 1s. That's fine, I guess. They may be such low risk, they're not making any money. But then once you get to a Camel 3 or a Camel 4, unfortunately, things are getting rough. And I don't know. Again, it's a secret, so it's hard to know exactly at what point the NCOA shows up and locks your doors and takes away your keys. You don't have a job anymore. But it's somewhere around Camel 4 or 5, I imagine. I know of other CEOs who've taken over small credit unions that are Camel 3s, and they really got to bust their tails to get it improved. But the examiners, I think, avoid increasing the number. So you stay the same for a long time until finally they can justify changing your Camel to a higher rating. But if you're a Camel 2, stay a Camel 2. You're happy. You don't need to be a Camel 1. I quit aspiring to that years ago, ever since that discussion with the examiner. I don't want to be a Camel 1. I like being profitable so I can give more back to my members.
Yes. So the board member Bible. Let's talk about board meetings.
Yeah.
What's the difference between what makes a great board meeting compared to what makes a terrible board meeting?
Yeah. Basically, they should be short and they should be at a nice restaurant over dinner. There you go.
Alrighty.
Where the chairman moves it along and the CEO has everything prepared and ready in the packet, ready to make a decision on, and you don't have to talk about things for hours and hours. Generally, a board meeting, if possible, the packet should be no more than 30 or 40 pages. That sounds like a lot, but that's probably pretty normal. Keep it under that. The meeting shouldn't go more than about an hour and a half at most. Otherwise, it's going to be hard holding on to good directors, and it just becomes exhausting and negative for everybody. Yeah. And you got to take them out to a dinner at a nice restaurant so you can sit down and everybody can eat, and it's not a time crunch, and you're treating them well, so they appreciate serving on the board, and I think you'll have them for a long time. We've had very low board turnover, and all our board members enjoy being on the board. And plus, if your credit union is doing well, it's fun to be on the board. If a credit union is healthy and you give them back to your members, and the CEO
especially if you're going out to eat too, do you go to the same restaurant every month, or you change it up?
We rotate it. We got 3 or 4 nice restaurants we go to. We go to a different one each time.
Okay.
And try to find a quiet one where you can kind of get in the corner or something, but that's huge. I do the same thing for a supervisory committee. And, the dinner costs a few $100, worth every penny to have a board that's happy and engaged and that's there every time. Supervisory committee, same thing. Matter of fact, I took my supervisory, they only come once a quarter for their audit. And we do about 45 minutes at the credit union, and then I take them out to dinner. And while we're sitting at dinner, I hand out the board packet minutes and the last exam results so they can look at it. We document it while they're eating a nice meal. And one of our supervisory committee, as she was leaving just a couple of weeks ago, she said, she's a new member of the committee. This is really nice. I really like doing this, and I'm glad we go out to eat. Yep. We got a supervisory committee member for life, and she's great. So.
Now, was your credit union doing board meetings at restaurants before you got there, or is that something you implemented?
I think they sometimes were, but they are also, I think, bringing food in. So the first few board members, I tried to cater food in because it was in the evenings, and it was a ton of work. And so my chairman's like, why don't we just go out to a restaurant? I said, deal. And ever since then, we've been doing it at restaurants.
Okay.
Yep.
Yeah, I should bring that up because we don't. I think I only know of one local CEO that does it at some restaurants.
Yeah.
Earlier before we started recording, we talked about conflicts of interest. What conflicts of interest do boards overlook?
I've seen situations where board members have friends or family that they're trying to enrich somehow through the business of the credit union, which is a definite conflict. I know of other ones where the board members try to control the CEO about who they should hire, people from their churches or their friends. That's another conflict of interest. I don't have a lot of specific details. I've heard stories. I've been lucky. I haven't had to deal with any significant conflict of interest while I've been here. There were some potentially before I started that I heard about word of mouth. So I don't have a lot of interest in conflict, but I go over what it is. But I don't have a lot of examples because if we had a lot of examples, I may not be here in front of you telling us today because that's like the death knell for your credit union.
Sure. Now, small credit union survival. What mistakes are causing some to disappear?
I think one of the biggest mistakes, I was actually listening, it's not a mistake, it's just happens. I was actually listening to the NCUA roundtable that just took place a week or two ago. And Sarah Bang talked about small credit unions disappearing and being merged out. She talked about how often it's a loss of passion, it's apathy at a small credit union. Over time, the board and the CEO, they all kind of get tired. They get kind of old. They kind of forget why they exist. They're not really giving special value back to their members. And pretty soon, when they're not really financially healthy because they're generic and boring and they're not really anything special to anybody, somebody drops a merger thing on in their lap and they're like, okay, what does it matter? There's really no difference between us and any other financial institution. So losing that passion is vital. And one way to cure that is, as a CEO, we need to be reminding our board members and sharing with them stories about the difference our credit union makes in our community, how we help those underserved people, the people that get overlooked by big banks or minorities or whatever our little niche is that we focus on, how we make a difference for people who really need it, that if we didn't exist, they'd have nowhere to go. People that would not get their loans approved by a big bank. It's up to us. We're the little hyper local community place. So sharing those stories, and the board as well needs to have a CEO who's passionate about that. And that really keeps the passion alive, and it helps make sure that we stay valuable and relevant, our credit unions, and that we exist.
Okay. Well, that kind of, I think we've gone through a number of the big topics.
You missed one big topic.
What's that?
You missed one big topic. The moral mergers.
Okay. So we briefly talked about mergers, but you've definitely been outspoken in preserving independent credit unions. What questions should every board ask before voting when they're looking at a merger?
Yeah, there's a lot of questions. And actually, I think the primary question, and this is a spicy one, and I have been quite outspoken on it.
Okay.
And sometimes, as I went over in the book, as a matter of fact, I just published an article on the CU Daily. I think it dropped today on this, and I kind of took it from my final chapter, chapter 13. How about that for a number? The moral merger chapter.
Okay.
And it's sometimes a merger is going to be warranted, and it's the best thing for the members, and it's the best thing for the credit union, and it makes sense because stuff happens. It's nobody's fault, and that's fine.
So
that's normal.
You said sometimes it does benefit. When does a merger benefit the member?
Generally, I think it's going to be if the credit union has lost its reputation to its members, so it's not really valuable or relevant in the community anymore, and it's financially struggling, and you lose like key management or something. It gets to a certain point when it probably just makes more sense. The members are going to get more value if you merge into a big credit union. If a small credit union can't give back better service or better rates, or can't approve loans for people that need it, and they can't compete with any of the big ones in town, and you're struggling and you can't turn it around, a merger may make sense. But generally, if a credit union, as long as you're healthy enough, it may just take a new CEO to really turn things around. Oh, but we can't find the talent. Find a college graduate, first job out of college, and give it a go. That's better than just dissolving your small credit union. Maybe they'll have passion and they'll be able to turn it around. And maybe you've got a bunch of capital you've built up for years, and you can use that money to really turn things around and improve your products and services and lower your fees. And if not, hey, the money, your capital belongs to the members anyway. You might as well use it all up before you merge out. Give it back to the members where it belongs.
So how should boards evaluate merger proposals objectively?
One of the biggest concerns here, I think, is the conflicts of interest. Often, and this is also why it's a concern when board members are kept in the dark, which is why I'm trying to get this book into the hands of board members. The board members who need it most may never see it, but I wish there was a way to get it into the hands of these small credit union board members who aren't really connected to the industry, and they maybe are only hear from their CEO and they don't hear from anybody else about what's going on. But often with mergers, there's merger-related compensation. Basically, the CEO is getting some kind of a payout. And if the CEO is getting some kind of payout, that is a conflict of interest. I don't know how to avoid it. And when that's happening, it's disclosed because it's required by law to be disclosed by the big credit union and before they take a vote. But how disclosed is it? I mean, is it on page 14 in the fine print with a hyperlink you have to type into your computer And way down on the last page, it mentions, oh yeah, and the CEO is getting a payout. If a CEO's, sometimes it's not the CEO's fault. Things happen, you got to merge. But if it's a failure of a CEO, and if they're merging out the credit union, why are you rewarding the CEO for failing? There shouldn't be compensation because you failed and your credit union is going to get merged into a big one. This is my opinion, and maybe I'm sure there's situations where that's not the case, and I'm not aware of all of them. But that's a real concern. So if there's merger-related compensation, any kind of compensation, that should be a concern, and the board members really need to take a look at whether a merger is really warranted. How healthy are we? Do we have a strong local value reputation? Do we just need a new CEO? So there's a lot of questions to ask, and I kind of put together like a big flow chart in there to go down, and I broke all those different concerns down and different aspects of how board members can look at it and assist them in analyzing whether it's really warranted or not. I was at GAC, the big congressional caucus that America's Credit Unions puts on last September, I think it was, and I was in one of the classes, and the speaker mentioned that of all the mergers that had happened the year before, probably only half of them were warranted. And what is there, 150, 200 small credit union mergers or something per year? Half of them weren't needed. But there was probably a conflict of interest. And the CEO's like, man, I was ready to retire anyway, get a big golden parachute. And they said they're gonna keep all the small credit union employees on. Usually small credit union employees are not gonna last at a big credit union. It's a totally different world.
Yeah, it's a complete different atmosphere. It's a different culture.
Totally different culture. Yeah, they're not going to the high sales pressure culture, whatever it is. It's just different. It's just very different. Anyway, so there's a lot of important, and often, they kind of. But this is the concern if it's a conflict of interest, because the CEO can be like, hey, here's why it's a great deal, and look, we get all these new products and services and expanded, and then. But if you really dig into it, which needs to be done, you say, well, what products and services do our members get they don't have right now? Really, exactly. Which ones are there? Because usually there's not very many. Usually they're really vague, or they're things like, special mortgage options. Okay, maybe, but you can still get that. You can still keep your small credit union. Or it's like, well, you get lots more branches. Where are the branches? Oh, they're about 1,000 miles from here. Is that really going to benefit our members? And then is it really worth losing their local financial institution that knows their name and gives them service and approves the loan when nobody else would? Anyway, so there's a lot of important questions I think need to be asked. Like I say, sometimes it makes sense, but board members, I really want to educate board members about the value of small credit unions and really how to determine whether or not it's warranted, which will not be very popular among a lot of circles, but the truth needs to be told. So,
yeah. Okay, real quick, before we finish, let's go through what I would refer to as a lightning round. So with answering it either with a one word or a very short, quick answer, I got a few lightning round questions for you.
This is where you're going to get the deer in the headlights. Look, here it comes.
Okay. Well, it was kind of interesting because I did one recently, and in each question delve kind of deep in them, but to kind of keep it a little light, what's the most important quality of a board member?
Caring. They just need to care, which means they're engaged. They've got to care about the members. They've got to care about making a difference to people that need it, and that's going to keep them on the board, and it's going to ensure they have integrity as well.
The most overrated board activity.
Overrated board activity. I do not know. I can't. There's not very many board activities that are required. So, which is part of my book points out. It ought to be easy to be on the board. It shouldn't be a huge burden at all. An hour a month. You got an annual meeting. That's another 1 hour a year. You got a strategic planning. Maybe another 1 hour a year. It's like 15 hours a year. Most overrated. I do not know. That's it.
I was just wondering if you thought maybe they got stuck on something, and maybe that's for more of our micromanaging board members.
Maybe so.
Okay.
Yeah. Probably.
Best advice for a new board member.
Don't feel embarrassed about asking questions. Ask the same question every month if you have to. It's
Yeah,
okay. That's
that's for anybody in all walks of
yep,
life.
yep, yep,
How about
yep.
biggest governance mistake?
Biggest governance mistake. Probably micromanaging. I would
Okay.
say micromanaging or lack of, and it's not a mistake. It's a sin of omission. Um, that's just not being engaged. The board members
Okay.
need to be engaged.
Now I know that we're promoting the board members Bible, but other than that one, what's the best leadership book besides your own?
Oh man, I'm no good at reading leadership books. There's this great book written by a guy named Greg Cook called Passion. Not what's it
Okay.
called?
Okay. Well, one answer, one word answer on this next one: coffee or tea.
Oh, for me? Oh, neither.
Okay.
I don't. I'm not really a coffee or tea drinker. I'm an LDS, so probably hot chocolate for me.
Okay.
I guess
Sure. There's nothing. Hey.
herbal tea. Actually, bone broth. I'm trying to get healthier, and so I've been doing a lot of bone broth lately.
There you go.
Yeah,
I think my daughter gets bone broth for her dog.
yeah. Oh man, I get the better one than that.
Hey, okay. So last closing question for you, Doug. If every credit union board member listening here today remembered only one lesson um, from the book, The Board Member Bible, what would you want that lesson to be? To go out and buy the book.
Right? Nope. I'm not going to take that one. I'll try to give you a better answer than that. Um,
It's literally there's so much stuff in there that's kind of a
there is, but
kind
I
of a
would
trick
say,
question on there.
but I would say, really, the most important takeaway is understanding that credit unions can provide a value to their community, especially to people who are underserved, who are overlooked by big institutions that nobody can replace. So the importance of making sure that you keep your CEO pointed in the right direction and that you're giving back to your members, the members who need it most. That's why we exist in the first place. And as long as they're aligned properly with our mission of helping people who need it most in our communities and our members, then everything else will fall into line. They'll be engaged. They won't want to merge. They'll care about the financials. They'll get a new CEO when they need it. So there you go. The understanding of really the mission of what small credit unions exist, which is not-for-profit cooperatives who are trying to help out the people who need it most, who are overlooked by big institutions.
Alrighty, there you have it, Doug. I want to thank you for sharing your experience, your passion for small credit unions. This has been one of our very good most dialogue episodes yet, and I think the number 2 one was the last one you and I did a couple months ago. So,
Right.
The Board Member Bible, just as in the leadership book, it's a practical guide to designing and helping volunteer directors make better decisions, support their CEOs effectively, and protect their members' interests, and preserve the cooperative mission that credit unions uniquely have. If
Thank
you're
you.
a board member, what?
Go ahead, finish up.
If you're a board member, CEO, or credit union leader looking to strengthen governance and build a healthier organization, this is an episode you'll want to share with your entire board, and especially go out there and it's actually reasonably priced. The book's about 30% larger than your CEO book. I think there must be some more information in there for the board members than the CEOs.
Yeah, I went a little deeper into financial ratios, and the merger thing was an exciting chapter, and that ended up having a lot to say there. And as a reminder too, it's written more to be a reference, so it's not like you have to sit and read it from beginning to end. You can jump right to a chapter if you're interested.
It really can be like their little credit union board encyclopedia that they can use for reference and use for their whole term.
Yep, and it'll also count. New directors are supposed to get trained, receive a financial education. Well, instead of spending $500, to have some third party train them,
Go
you
to,
can buy them this.
they can literally go to Amazon and get the book.
Yeah, I'm surprised there hasn't been one written before. That's the other thing that surprised me. It's kind of like this book, the Keep It Simple. There were no other books that were written for a small credit union CEO, like none. And so same with this. I was like, has anybody ever written a book for a board members of small credit unions? No. So there it is. So
hey, you found the niche. They said there's riches and niches.
Right. Maybe not so much here, but at least there's value, I hope.
Alrighty, well, thank you again, Doug. I appreciate your time. It's been excellent, and hopefully our listeners get a lot out of it as well.
Thank you, Greg. I hope so.